Welcome to Module 4, Section 4, where I will go over some of the types of orders that you may encounter in the stock market.
So what are the different types of orders that we have available to us? Now, what I'm going to cover are just the most common types of orders. Each broker might have things a little bit different. It may be different if you're talking to your broker on a phone or if you're in person than if you're doing it on the computer, and each software package that you use might be a little bit different in how they approach things. There are lots of different orders that you have available to you. This can include when you enter a new position or when you exit an existing position. Those are really what we're trying to do, get in and get out. And there are different types of orders that you can use. Some of the most common orders are a market order. That's whatever the market is at any given time. A limit order, only get in if my price is hit. So if you set a limit order of 10, that means that you get in if 10 or below is hit if you're looking to buy, or 10 or higher is hit if you're looking to sell. Let's talk about market orders. A market order is an order to buy or sell immediately at the best available price. There can be a lot of what we call slippage with this. You may think that you're getting out at 20 when you actually get out at 19.5 or at 21. It can work against you or it can work for you. A price is not guaranteed, but it is usually guaranteed that you'll get this filled immediately. Let's say that you're in a position and there's some time attached to it. You have to get out by the end of the day. Your price is just not being reached. It's getting really close to the close. And so you just put in a market order just to get out, where you're not as concerned so much with the price. You're more concerned with actually having it executed. Because there are lots of times when we put in orders and it can take a long time for that order to be executed. You may get impatient, or you may be dependent upon that because you're using other investments and you need something to be executed. What happens during the execution is when you're buying, if you're going to buy a stock or an option or a futures contract, you will pay a price near what's called the ask price. That's the price that you pay to buy. And if you don't quite understand bid and ask price, I have another video that I would really recommend that you watch. When you're selling either a stock or a futures contract or anything, you will receive near the posted bid price, BS, bid, sell. That's how I remember that. So there are two prices at any given time. There's some caution that we need to take when we're looking at market orders. The last traded price is not necessarily the price at which the market order will be executed. If you bought at 10 and you're looking at getting out at 15 and you go, oh wow, the last trade was at 15, I'm going to put in my order right now as a market order, it doesn't necessarily mean that you'll get filled at 15. It might be lower than 15, but at the same time, it might be a little higher than 15. What we're trying to do is control the environment as much as we can. There are certain things that we cannot control, but there are other things that we can control, and we want to take advantage of that. In a fast-moving or volatile market, the price at which you actually get filled or when the trade is actually executed can deviate a lot from the last traded price. If you were trying to get out during the COVID plunge and you put in your order, the markets were going so fast to the downside that your actual fill price may be very different from what you thought it would be. Since you entered a market order, by the time it gets to the floor and gets executed, the price could be very different from what you're looking at on your screen or from what your broker's actually telling you. The price will remain the same only when the bid-ask prices are precisely at the last traded price. This is how the stock market works. If there's a lot of people looking to buy, the ask price gets pushed higher and higher and higher until nobody else is willing to buy. The inverse is also true. If people are looking to sell, the bid price will go lower and lower and lower until there's nobody left to sell. The only time you're going to get the exact same price is if your trade is executed when the bid and the ask price are the same as the trade that you just saw, because they're constantly moving. This can change hundreds of times even within a minute. This is especially true of very liquid stocks or stocks that have a lot of volume. If you're trading stocks that don't trade all that often, the bid-ask will still move even when no trades actually take place. So it's usually a good idea to watch the bid and the ask more than it is the actual price that was traded. You don't know if that price was a buy or a sell. You don't know if it was conducted at the ask price or at the bid price. Market orders are popular among individual investors who want to buy or sell a stock without delay. There are times when you get in and you just say, okay, I've made my decision. Even if there's some slippage on the execution of this, I'm happy with that. Let's just light this candle and get it going. So you just get in with a market order. You're tired of waiting around after you got up the courage to even enter a limit order, and now 10 minutes passes and an hour passes or a few hours pass and nothing happens, and you're getting impatient and you may not be able to sit at a computer all day, so you cancel that limit order and go ahead and just place a market order. Although the investor doesn't know the exact price that you're going to get in or get out, whether you buy or sell, market orders on stocks that trade over tens of thousands of shares per day will likely be executed close to the bid and ask prices. One rule of thumb is the greater the volume, the tighter the bid-ask spread. So we want to be involved in things that have a lot of volume and what I call liquidity, the ability to get in and get out quickly. So I wouldn't even look at stocks that trade tens of thousands of shares. I'm looking at stocks that trade tens of millions each day. Now let's talk about limit orders. A limit order sets the maximum or minimum price at which you're willing to buy or sell. If you're looking to buy, I don't want to pay anything over 10. I'm willing to pay less than 10, but nothing over 10. If you're looking to sell, I don't want to sell at anything less than 15. I'm willing to sell above 15, but I don't want to sell below 15. So you can set these limits up. And usually it's pretty easy to do. You can either say that to your broker or set it up on your software that you use. For example, if you wanted to buy a stock at 10, you could enter a limit order at $10. Very simply put. So if the stock is trading at 12 or 11 or 15, if it never comes down to 10, your order will never get executed. It will only get executed if it comes down and actually trades through 10. This means that you will not pay a penny over $10 for that particular stock. Now, it's not quite as simple as this, because once your limit order hits the floor, it becomes a market order, and if things really start to gyrate around, your fill price may not actually be at 10. It might be in your favor or against you. But the idea is that it didn't even kick in until you hit that price because you put that limit order in. It is still possible, however, for you to buy it for less than 10. Now, personally, that makes no sense to me, and I have my own philosophy behind that. But if you're looking to buy something at 10 and it's dropping in price and you want it to go up, that makes no sense to me at all. If you're buying something hoping it should go up, it should already be going up at the time you buy. But that's just my personal philosophy. Most brokerages will charge the same fee for market and limit orders. They used to be different. Now with technology the way it is, you just hit some buttons in your software. It's really no different to your broker. This can vary. So if you've been dealing with a broker for a long time, you may want to double check this just to see if I enter a market order or a limit order, am I going to be charged the same commission or fee? And there's a lot of brokerages out there now that don't even charge commissions. They make their money other ways. The understanding was at one time it used to take more work to place a limit order because you had to be put into the system, and now you're waiting in line and they had to write it down in a book and then erase it if you changed it. Well, with everything being computerized, it's really pretty easy now. Let's talk about a thing called stop orders. And some of you may use these, and I would recommend that you use them as well. Not all the time, but in most instances. This can also be referred to as a stop loss order. And if you think about it, it makes sense. If you buy a stock at 10 and it falls to 8, you put in a stop loss order at 8, that means you're done, you're out. It kicks you out of the market. Because if it goes to 7 or 6 or 5, you've protected the rest of your investment. This can also be called a stopped market, where it's a stop loss order that's executed as a market order, but it only kicks in if the market reaches that level. On stop buy, so you may put in an order where you want prices to fall to a certain level, and you're initiating that position with a buy, and so you would put an on stop buy order in, as opposed to an on stop sell. Now, I use a little different terminology. I look at buying to open or buying to close, selling to open or selling to close, and that's more familiar to me. And the software that I use, that's how they do things. This can be a beneficial type of order. The order is different because unlike a limit or a market order, which are active as soon as they're entered, this type of order, the stop order, remains dormant or it doesn't do anything until a specific price is passed, at which time it's activated as a market order. A lot of investors use these. If you have a stock that you've held on to for a while and it's at $60 per share, and you think, I've had a pretty good run with this. I'm going to be away for a little while. I can't really watch things. I'm going to put in a stop loss at 55. So if prices do fall, it executes whether you're watching or not watching it. Another thing that we use very heavily are called stop loss orders. Each person will need to determine if using a stop loss order is the right thing to do. Now, why would I say that? Shouldn't that always be the right thing to do? Well, some traders and investors like to use mental stop losses. They come up with a figure in their head and they say, okay, if we trade down through this price, I'm going to go ahead and put in a market or a limit order at that price. Where other people just like to set it and forget it. Where you set your stop loss up, you don't have to worry about it anymore. You may come back at the end of the day and go, oh yeah, I see where my stop loss order kicked in and now I'm out of the market. Here's the concept. This is what I would recommend if you trade or invest in stocks. Let's say you buy a stock at $10 per share, and before the market even opened, you did all your homework, you've developed your strategy, and you know how much you're willing to risk on this position. So you set an initial stop loss at $8. The evening or the weekend before you sat down, you figured all of this out. You're willing to risk 20% of your capital. And as long as it stays above 8, you'll stay in that position. So there is a 20% risk. Some people don't want to risk that much. They only will risk 10%. Some people say, 50%. So everybody's going to have a little bit different amount that they're willing to risk before they admit, okay, I was wrong about this. Let's move on to the next one. So let's say now you're right and the stock climbs to $11. You bought it at 10, it's up to 11. So what do? The existing stop loss is canceled, the one at 8, and you replace it with a new stop loss at 9. So now instead of having a 20% risk, you've lessened that to a 10% risk. And what happens if the stock climbs to 12? Now this could happen in a few days, or it might even be a few years before this actually unfolds. I'm just trying to show you the concept. The existing stop loss is canceled and then replaced by a stop loss at 10. So you got in at 10. The price is now at 12. You set a stop loss at 10, so now you're at break even. And believe me, this is a nice place to be. To know that other than slippage and commissions, you're going to break even at that point. And that's when you can relax a little bit and just watch things. You don't have as much risk at that point, so that if things do go against you, at least you're going to get your money back. The idea is to adjust your stop loss orders until a position is exited. This is usually referred to as a trailing stop loss. So this example that I was using, let's say it goes to 15, and now you have another stop loss at 13, and then it goes to 20. So you set another stop loss at 18, and you just keep doing that over and over and over. Eventually, let's say it gets to 30 and you set a stop loss at 28. Finally, things turn against you. It comes down, hits 28, boom, you're out of the market. So you now have a stock that you got in at 10 and you got out at 28. It's a really good return at that point. We also have different types of all or none, AON orders. All or none orders ensures that you get either the entire quantity of stock, or this is what we use a lot with options. If you're using multiple options at the same time, you want all of them filled or you want none of them filled. So either it all happens or none of it happens. This is typically problematic when a stock is very illiquid. It doesn't trade very much. Or if there are options that don't trade very much. Or a limit is placed on the order. But you can do that. And you can treat it all as one unit. So if you're doing an option strategy where you're buying and selling at the same time for either a debit or a credit, you can put the order in for the price that you want to be filled at or the price that you want to sell. You're not necessarily focusing on the price of the options themselves. Execution can be spread out over a period of time. If you do a thing called covered call writing, where you own stock and then you sell options against that, and that can be a good way to generate income. I've had a lot of these trades where they've taken place over a long period of time, which when you're in the market and you're looking to sell some options, and you might sell 2 options here and then 3 options and then 5 options and then another 10 options, you're getting multiple fills all at the same time. According to you, everything that you wanted to sell got sold, but it can be a little nerve-wracking when it's spread out. So if you do these kind of orders, they are more complicated. They're less likely to always get filled unless you deal with very liquid markets. That's another reason why I really like the S&P 500 and all of the instruments that are attached to it, because they tend to be very liquid. This can be similar to a fill or kill order. So either fill all of it or fill none of it. And if you can't fill all of it, then kill it. Just let it die right there. The price and size must be executed. If you're dealing with shares, that will be 100, 200, 300 if you're using a lot. Or if you're doing option contracts, it'll be 1, 2, 3, 4, 5 contracts that you're trying to get filled at. So that's the size. And then you may also put limits on the price. And both of those have to be met for the trade to be executed or the order is canceled. Then we have a thing called a good till canceled order. Or this is just called a GTC. I know that's a poorly made acronym, but it's what the market uses. The order is typically used when you have an existing position. A good till cancel order will remain active until it's canceled. So you can set it and forget it. You place the order and then you can go away and do the other things that you need to do. And that order is still sitting there, kind of like a stop loss order. And it sits there either to buy or to sell until you come in and actually cancel that order. Now, there are some limitations because they had people that were forgetting all about this and didn't know that they had an order out there. So they usually do have a time period on them. Brokerages will typically limit the maximum time that you can have a GTC order to 90 days or about 3 months. So if it hasn't executed during that time, it's automatically canceled. Then we have a day order. I bet you'll never guess what that means. A day order only lasts for 1 trading day. Woohoo! This means that after the end of the trading day, the order will expire if it wasn't filled. If there wasn't a transaction, meaning that the order was filled, it will have to be re-entered the following trading day. I tend to use a lot of day orders myself. I set them up. If they don't execute, they're all gone, they're wiped off, and then I start the next day brand new. Then we have different complex orders. Numerous additional types of orders can be entered. And some of these can get kind of crazy. You think about your situation, multiply that by all the different market participants, it's no wonder that our brokers can even keep this stuff straight. It's a good thing that we have computers to do this. More complicated orders are usually involved when implementing more complicated strategies. There's a strategy where you buy a stock and then immediately sell the option. That's a buy right. And you want both of them to be executed at the same time. As I mentioned before, there are different complicated option strategies where you want the entire order to be implemented at the same time, or you don't want any of it filled at all. And these are considered to be more complex types of orders. These order types will be covered when they apply to a specific strategy. And I teach a lot of different strategies and the different types of orders that you should use. So what are some thoughts that I have on orders? Most often, most investors set limit and stop loss orders at round numbers. So if you want to get into a stock and you place an order at 10, well, there's a million other people that also want to buy it at that price, and they're all lined up to buy at a round number. Instead of putting a stop or buying something at 10, you might want to consider putting your order in at $10.05 or $9.95, a little bit off of a round number. Human beings, being what they are, we like to deal with round numbers. Why do you think all the stores sell things for $9.99 or $13.99? That's because in our mind, we're thinking the 9 or the 13 is the dollar amount, when really we have to go one up. It's really $10 or $14. Since we do that in our mind, don't you think we'd want to set up our orders at slightly different prices so that we don't have a whole flood coming in? Because if you have a lot of buy orders set at a round number and you're one of them, the minute that price gets hit, that turns into a market order and your fill price could be quite a bit different than what you thought it would be. Make sure you understand if a position is being opened or closed. Are you buying to open or buying to close? Are you selling to open or selling to close? There's been some times when students that I have, they get in and they go short, so they sell to open, and then they get in and they think that they're going to close out this position, but they sold to open again without really realizing it, and instead of their position being closed, now they have a position double the size they had before. And this is especially true if you talk to your broker. It's a little bit easier to handle with computers because we have buttons that we can push and things that we can read. But you can get tripped up in your words a lot. And that's why brokerage outfits will record every phone conversation. In case you come back and say, I didn't do that. Well, here's a recording of you saying exactly what you said you didn't say. So you want to be able to buy to open and specify that when you're placing the order. That's what you do if you're going long. You want to buy low and sell high. You can also buy to close if you're in a short position. That means that these transactions are taking place at the bid or ask price. So whenever you buy, that is being transacted at the ask price. And it can be different than the bid price. And if you have questions about that, I do have videos that talk about bid-ask prices. Or sell to open, which doesn't make sense to a lot of people until you take my program. Or sell to close. You have to differentiate between what is actually happening. Any order is turned into a market order if the criteria for it to be filled has been met. And I've explained that. You may have a limit order. The criteria for that order to be executed has been filled. Boom, it gets shot off to be executed. It becomes a market order at that point.
This concludes Module 4, Section 4, and I will pick up with things again in Section 5.